Options for beginners, part 3. This part is taking a look at how options let you make money with stocks in unique ways that not a lot of people have caught on to yet. You can buy stocks at a discount. You can generate cash flow without owning any stocks, or if you do own stocks, you can actually generate cash flow based on those stocks as well, and not just through dividends. While you are learning about this, an important consideration is what your goal needs to be. What's your freedom number? What's your retirement goal? Or what are you trying to achieve by generating cash flow through stocks? Do you want to make money on the side? Do you want to build wealth? Do you want to retire early? How do you plan to get there? How do options fit into that plan? We just released a case study. It's called The Ultimate Side Hustle for Canadians. It's completely free if you want to download it now. It's a report where one of our team members has done Amazon e-commerce, multi-level marketing or network marketing, real estate. He's a real estate investor, heavily invested in real estate. He's also a successful stock hacker. We take a look at those 4 side hustles, by the number breakdown. How do each compare to one another? Time investment, money investment, what did he get out of it? So if you want to download that report, it's The Ultimate Side Hustle for Canadians. Link is in the description below. So let's keep going to stock options. So again, options let you buy stocks at a discount. They let you generate cash flow without owning stocks. If you do it right, you can cash flow with stocks that you already own. Can also provide a barrier or a buffer should the market correct a little. Stocks also have an ugly side, so you do need to be careful. How do you properly make money with stocks? First, let's recap some of the basics. So this is part 3 in a 3-part series. The first part, Options for Beginners, part 1, we looked at what you needed to know to get started in stocks. Part 2, we really dove into what options are, the foundations of it. So there might be some terms in this video that you don't understand. Go back to Options for Beginners, part 2. You're going to see key terms like strike price, expiry date, underlying stock. What does it mean to be that they are derivative investments? All of that jazz. So if you need to brush up, take a look at part 1 and 2, then come back here. The first, what we'll call secret tactic to make money with stocks is buying stocks at a discount. Okay, so let's say you like XYZ stock, but you don't want to pay its current price of $97. Maybe you'd rather buy it at 93. It's just a more comfortable level for you for whatever reason. Now, you could put an order in and just wait for the stock to drop, and it might never. You don't know. In that case, you kind of have to wait and hold that money aside should something happen, right? The other option, pun intended, is to sell a naked put. Okay, again, naked puts are defined back in options part 2, but let's kind of review. A naked put allows you to make a promise to buy shares from someone at a specific price. So you could promise someone that say, hey, you own XYZ, 100 shares, always 100 shares, all options contracts are 100 shares. You could promise someone to buy 100 shares of XYZ at $93. That's like insurance for them. You make that promise, they know they're never going to lose more than $93 on those shares, which might be a really good thing for them. They might have bought at 83, who knows, it doesn't matter. The point is they're willing to engage you in this contract. So for that promise, for insuring their shares at $93, they're going to pay you a premium like every other insurance company out there. In this example, let's say the premium is 95 cents per share. That's cash up front, 95 cents per share, cash up front premium. But you're now engaged in this contract. If the price falls below $93 in the next 31 days, the buyer can the buyer of that put can exercise their right to sell you these shares, and put these shares into your account. That's kind of where the name comes from. Just means that you're forced to buy the shares. Okay, so you just bought 100 shares of XYZ at a price you like, $93, but you also collected 95 cents per share of premium up front. So $93 minus $93 per share minus 95 cents per share comes out to $92.05 per share. So while the current price hovers around $93, you only paid $93.05. Sorry, $92.05. You just bought stock at a discount. And instead of waiting for the stock, you still kind of had to wait for the stock to crash, and you still kind of had to have that money ready to buy just in case, but you collected money up front. So it's like a bonus for that waiting period, right? That's how you buy stocks at a discount. That's how options can allow you to buy stocks at a discount. Secret tactic number 2 to make money with stocks: you can generate cash flow without owning stocks. So let's say in that example, you're waiting for XYZ to drop to $93. Let's say it never does. You have this, you collected this premium of 95 cents per share for 100 shares, and it never hits that 93 mark, not in that 31-day window anyway. 100 shares times 95 cents per share is $95 total premium collected. So at the beginning of this contract, $95 would have been deposited into your account right away. Cash in your account immediately. Some of you are already starting, the gears are already starting to turn. I can see it. If the price stays above 93, you keep that premium, but you don't have to buy shares. You just made money without owning anything. You keep the $95 premium and you move on. You can do that again. You can write another put contract, collect more premium, and see what happens. So theoretically, you can sell naked puts to generate cash flow even when a stock price drops. So it could drop to 93.01. It wouldn't make sense for the buyer of that put to exercise that contract to put those stocks into your account, because they're selling it at 93.01. Sorry, they're selling it at 93. That's the contracted price. That's the strike price. The actual price is higher, plus they paid you 95 cents on top of that. Just doesn't make sense, right? So they're not going to exercise that contract. They're not going to put those shares into your account. So it still makes sense to sell shares with stocks that are trending upward. Like it can cause you a lot of anxiety if you see a stock plunging towards your strike price and you're not sure about exactly what's going to happen. You still want to make sure that you are protected on some level, and you need to make sure that you have the cash available. Even though you're not technically buying any stocks right away and may never have to buy stocks, you still need to have that cash available just in case. Otherwise, you're in trouble and your broker will literally come calling, or they don't call and they just take action on your account without you having to, without even addressing you. That's called a margin call. You can look it up later, or we'll actually do a video about margin calls later because they're scary. So make sure you have the cash available. All right, so you can, to recap, you can, if you get assigned the stock, you've just bought stock at a discount. If the shares get put into your account, you just bought stock at a discount. If you don't, you just keep cash and you get to keep doing that until you do get assigned or until you choose to use another tactic, another strategy. So there's 2 ways to make money that not a lot of people know about. And a third way is to make money on, generate cash flow on shares you already own. Let's say those shares get assigned. Let's say that initial, it drops to 93, it gets assigned. So your average cost for XYZ, 100 shares of XYZ, is 92.05. You're happy owning it at that price. But you also say, but you also want to keep collecting cash. You like this cash flow idea. Who doesn't? You can sell what's called a covered call. Again, this is defined in Options for Beginners Part 2. It is a promise to sell those 100 shares at a specific price by a specific date, okay? At a strike price by an expiry date. So you're thinking, you know what, I wouldn't mind getting rid of these shares at 107 bucks. I paid my average cost was 92.05. I could sell at 107, I'd be happy. Someone comes to you, they think that this stock is gonna go to 207. And so they're happy to buy it from you at 107. Well, you can say, okay, I promise to sell you at 107 and 31 days. For that promise, pay me 50 cents per share. So again, you are the seller of this option contract. Now you are obligated, should certain conditions be met, or should even the buyer just choose to exercise that contract, but you are collecting premium. In this case, let's say the premium is 50 cents per share. Two outcomes are possible here. One, the price never reaches 107. The conditions are never met. So the buyer of this call contract is not going to want to take action on it. It doesn't make sense for them. If the stock price is at 105 and they're promising to buy at 107, they're not going to do that. They don't have to. It's their right, but not their obligation. So they're just going to let it dissipate. Nothing happens. You keep the $50, 50 cents per share. You keep the $50 premium, and you can, again, write another covered call on that. Or the price goes over 107. Your shares get called away. You sell the shares to this call buyer, and you still keep the premium, and you win all around. Now, I've kind of sped through this, but some of you probably already connecting the dots and starting to see a cycle happening here. And this is secret number 4, okay? This is a specific strategy. It's called the wheel strategy. It can work often, but it doesn't always work. But here's how it works. Sell the naked put, collect premium. Let's say you get assigned the shares. The conditions are met. In this case, the conditions are met. You buy the shares you have to buy the shares. You now have these shares of XYZ. That's called getting assigned. Now you have shares in your account, so you can sell covered calls. Sell covered calls, collect more premiums. If your shares get called away, just write another naked put. Naked put, covered call, naked put, covered call. It's this cycle, it's this wheel. Now, this whole cycle can get significantly slowed down. Let's say that price plunges. Let's say in this example, XYZ, $93 per share is your strike price. It plunges to $83. It's going to take a little bit to climb back up to that point. You don't want to write a covered call. Like, you're not going to write a strike price on a covered call to sell those shares again under $93, or even under, say, $92.05, which would have been your break even because of the premium that you collected. And you may not, without going into the nitty gritty, this isn't foolproof. It doesn't work always. However, on a stable stock, this can be a significant stream of income. So you can see how combining these option strategies can begin to generate income in your account. And it's not like it's happening every day. We're talking about 31-day time frames. Sometimes you can get out sooner and maybe turn it around in a week or 2 weeks or 3 weeks. But it is still money in your account that wasn't being generated before, right? So what are you supposed to do with all this info? Well, there's a lot of learning that still needs to happen here. But if this is a side hustle, that you think you'd like to investigate more, again, I want to revisit the ultimate side hustle for Canadians. If you're looking for a way to generate extra cash flow, okay, take a look at this comparison that we built up for you, this case study that we've put together for you. MLM, Amazon e-commerce, real estate investing, stock hacking, stock option trading. See how the numbers and the time commitment stack up. Sometimes we discount the time. Okay, you can download that report for free in the description below. Otherwise, that wraps up our series. Thanks for watching. Don't forget options for beginners part 1 and part 2. If you like this kind of plain language explanation of specific stock market and stock option topics, make sure you subscribe to our channel. Every week we drop, whether it be educational pieces, how-to videos, or deep dive videos. Like last week's, it was Airbnb, why Irwin bought Airbnb on the dip. In the future, we want to do a deep dive on a company called Hut 8, just fundamental analysis. If you like that kind of thing too, that's what we're releasing here. So again, thank you for watching. We'll see you next time.